In early 2012, a creative professional could walk into a technology retailer, hand over $2,500, and walk out with a heavy, shrink-wrapped cardboard box. Inside this physical box lay Adobe Creative Suite 6. It contained installation disks, serial numbers, and a permanent license to the most powerful digital creation tools on the planet. When you bought that box, you owned the software inside it. You could install it, disconnect your computer from the internet, and use it every single day for the rest of your life without ever paying Adobe another cent. That box represented a physical transaction, a capital expenditure, a finished product. It was also the anchor of the most profitable franchise in the history of creative technology. Yet inside Adobe headquarters in San Jose, executives were preparing to do the unthinkable. They were preparing to take that $2,500 box and intentionally destroy it. They were about to commit corporate sabotage against their own flagship product. In May 2012, Adobe announced it would no longer sell permanent software licenses. Instead, users would have to pay a $50 monthly fee every month forever. If you stopped paying, your tools stopped working. The decision defied conventional business logic. Why would a dominant, highly profitable company willfully alienate its entire user base, invite a massive consumer revolt, and deliberately crash its own quarterly revenue? The answer lies in a brutal mathematical formula known as the SaaS fish curve. Adobe did not just change its pricing strategy, it engineered a permanent extraction mechanism. By intentionally plunging the company into a terrifying financial valley of death, Adobe leadership forced the entire global technology ecosystem into a new era. They wrote the definitive playbook for the modern subscription economy, transforming a stagnating $15 billion company into a $200 billion recurring revenue juggernaut. In doing so, they quietly erased the very concept of digital ownership. This is the story of how Adobe burned its own empire to the ground just to ensure that you would never actually own your tools again.
To understand why a company would willingly detonate its primary source of income, you have to look at the silent rot eating away at Adobe inside the late 2000s. On paper, Adobe looked invincible. Photoshop, Premiere, and Illustrator were undisputed industry standards. But inside the company SEC filings, a different narrative was unfolding. Revenue was flatlining. Adobe was trapped in what the software industry called the 18-month death march. Under the old physical model, Adobe spent a year and a half quietly pouring hundreds of millions of dollars into research and development. Engineers coded new features, marketing teams designed massive global campaigns, and supply chains manufactured millions of physical disks, manuals, and boxes. For 18 months, Adobe spent heavily while earning relatively little from new releases. Then came the launch. A massive spike in revenue would hit the balance sheet as agencies and professionals bought the new version. The company celebrated, the stock popped, and then the brutal cycle began all over again. But by 2010, this 18-month death march was breaking down. The software had become too good. Creative Suite 4 and Creative Suite 5 were incredibly powerful. When Adobe released a new version, a terrifying trend emerged. Users simply skipped the upgrade. A graphic designer who paid $2,500 for CS5 felt no urgent need to spend that money again 18 months later just for a few incremental features. The upgrade market was saturated. Adobe was competing against its own past success. Worse, the high upfront cost created another existential threat: rampant industrialized global piracy. Because a single master suite cost as much as a used car, Adobe products became the most pirated software on the internet. BitTorrent trackers and hacker forums were flooded with keygens and cracked installation files. Millions of students, freelancers, and international users relied on Photoshop every day, but Adobe captured exactly $0 from them. The company's legal and technical teams played an endless, losing game of whack-a-mole against global piracy syndicates. Adobe was the undisputed king of a dying business model. They had total market dominance, yet they were entirely dependent on unpredictable, cyclical hits. If a new release fell flat, the company faced a massive revenue shortfall for the next year and a half. Wall Street hates unpredictability. Investors value recurring, predictable cash flows over massive, erratic spikes. Adobe's executive team, led by CEO Shantanu Narayen, looked at the internal projections and saw a cliff approaching.
They realized that selling a perfect finished product was actually a strategic vulnerability. If a customer only pays you once every 5 years, you do not have a customer, you have a hostage negotiation. The physical box was a barrier to entry. It forced users to make a massive capital expenditure. Narayen knew that to capture the millions of users pirating the software and to extract more total lifetime value from legitimate professionals, the fundamental nature of the transaction had to change. The product could no longer be a tool. It had to become a utility. Like electricity or water, it had to be metered, controlled, and billed continuously. But transitioning a legacy enterprise from physical sales to a digital subscription model had never been done at this scale. There was no playbook.
And to execute this pivot, Narayen would have to guide Adobe into a financial abyss that terrifies every public board of directors. He would have to deliberately crash the company revenue. In corporate boardrooms, the transition from selling a physical product to selling a digital subscription is illustrated by a terrifying mathematical line graph known as the fish curve or the J-curve. It is the valley of death for legacy companies. The mechanics of the fish curve are brutal and unforgiving. Under the old model, Adobe recognized $2,500 in revenue the exact moment a customer walked out of a store with a box. It was a capital expenditure for the buyer and an immediate massive cash injection for Adobe. Under the new software as a service model, that same customer would pay $50 a month. This shifts the purchase from a capital expenditure to an operational expenditure. From an accounting perspective, the immediate impact on the seller is catastrophic. When you switch a customer from a $2,500 upfront payment to a $50 monthly payment, your recognized revenue for that quarter instantly evaporates. You're trading a mountain of cash today for a slow, steady drip of revenue over the next 5 years. For a publicly traded company measured by quarterly earnings, this creates an optical illusion of total collapse. During the transition phase, operational expenses remain incredibly high. The company still has to pay engineers, maintain vast new cloud servers, and fund aggressive marketing. But the massive spikes of upfront revenue vanish. The financial graph plummets downward, forming the deep belly of the fish. This is the valley of death. The company bleeds cash, profit margins disintegrate, and net income falls off a cliff. For a CEO, entering the valley of death is professional suicide unless the board of directors and institutional investors hold their nerve. Wall Street algorithms and reactionary traders typically dump stocks that show declining revenue. The pressure to reverse course and offer a quick, profitable boxed release becomes overwhelming. Shantanu Narayen and his executive team modeled the J-curve extensively. They knew exactly how deep the valley would be. They calculated that it would take roughly 3 years for the cumulative monthly payments to finally overtake the lost upfront sales. 36 months of intense financial pain. 36 months of angry investors. But the corporate math on the other side of the curve was intoxicating. If a user paid $50 a month, they would spend $600 a year. After 4 years, that user would have paid $2,400. After 10 years, $6,000. And the genius of the model was that the user could never stop paying. If a freelance designer hit a financial rough patch and canceled their subscription, they did not just lose access to future software updates, they lost access to their own past work. Every proprietary project file, every layered Photoshop document, every Premiere video timeline would become locked and uneditable. The subscription model did not just capture recurring revenue, it captured the user's entire digital livelihood. Narayen presented the plan. Adobe would stop developing the boxed software entirely. They would force every user onto the cloud. There would be no hybrid model, no safety net, and no permanent licenses. They were going to jump into the valley of death, burn the ships behind them, and force millions of creatives to jump with them.
On May 6, 2012, Adobe made the historic announcement. Creative Suite 6 would be the final boxed release in the company history. Going forward, the software ecosystem would be rebranded as the Creative Cloud. Users would pay a monthly subscription fee, requiring an active internet connection to verify their license status. The reaction was immediate, visceral, and overwhelmingly hostile. Across the internet, creative professionals realized exactly what Adobe was doing. The marketing illusion of the cloud was quickly stripped away. Users understood that their essential daily tools were being held hostage. Viral petitions erupted on platforms like change.org, gathering tens of thousands of signatures in a matter of days. High-profile designers, photographers, and independent filmmakers publicly threatened to boycott Adobe products entirely. Industry blogs published blistering editorials accusing the company of monopolistic extortion and corporate greed. Competitors sensed blood in the water. Smaller software companies launched aggressive marketing campaigns, offering permanent licenses for their alternative tools, explicitly targeting angry Adobe refugees. But Adobe possessed a structural advantage that made the global boycott impossible to sustain: the absolute lock-in effect of proprietary file formats. The creative industry runs on collaboration. A video editor must hand off a project to a colorist. A graphic designer must send a layered file to a commercial printer. If you refused to subscribe to the Creative Cloud, you could not open the files sent to you by clients or colleagues who had already upgraded. The network effect weaponized the subscription model against the resistance. Protest was futile when non-compliance meant professional isolation and immediate loss of client work. Despite the massive user outrage, Adobe held firm. And then, the grim financial reality of the fish curve hit the balance sheet. In 2013, Adobe's SEC 10K filings painted a picture of absolute devastation. The company reported net income plummeted by a staggering 65%. Revenue contracted sharply as the massive upfront sales vanished. By all traditional Wall Street metrics, the radical transition looked like a colossal failure. Financial media published deeply skeptical reports. Analysts openly questioned if Narayen had fundamentally miscalculated the elasticity of consumer demand. The company was deep in the valley of death, bleeding out the massive upfront cash flows it had relied on for decades. Inside Adobe headquarters, executives ignored the panic and obsessively tracked a new metric that would soon become the holy grail of modern technology: annual recurring revenue, or ARR. They ignored the collapsing net income and focused entirely on the pace of subscription adoption. And inside the data, they discovered a hidden behavioral truth about the software-as-a-service model. Once a user entered the subscription ecosystem, the psychological friction of paying $50 a month was significantly lower than the massive hurdle of spending $2,500 at once. The industrialized piracy problem evaporated almost overnight. Millions of students and independent freelancers in emerging markets who had never paid Adobe a single cent suddenly found a $10 or $30 monthly tier highly affordable. The total addressable market exploded globally.
The company was actively monetizing users it had never been able to reach before. Through 2013 and into 2014, Adobe endured the financial trough. The executive team fielded hostile, aggressive questions on quarterly earnings calls, methodically explaining the J-curve mechanics to impatient analysts. They refused to blink. They did not release a stopgap physical version to temporarily boost quarterly numbers. They forced the entire market to bend to their strict financial will. And then, the lines crossed. By late 2014, the compounding growth of annual recurring revenue finally mathematically surpassed the lost revenue from the dying boxed sales. The fish curve arched violently upward. The slow drip of monthly payments accumulated into a raging river of recurring capital. The transition was complete. The massive gamble had paid off. Wall Street suddenly understood the sheer scale of the extraction engine Adobe had built. Institutional investors realized that Adobe revenue was no longer subject to the unpredictable hits and misses of an 18-month product cycle. It was guaranteed, automatic, and infinitely scalable across the globe. The stock price, which had stagnated for years under the old model, began a meteoric ascent. Adobe transformed from a vulnerable $15 billion software vendor into a $200 billion titan of the digital economy. They had survived the valley of death, and in doing so, they provided undeniable mathematical proof that the subscription model was the most lucrative mechanism ever devised for software monetization. The corporate execution was flawless, brutal, and historic.
The aftermath of Adobe pivot extended far beyond San Jose. The 2012 transition to the Creative Cloud became the defining business case study for the entire technology sector. Software executives across the globe studied Adobe SEC filings, dissecting the exact mechanics of how Shantanu Narayen survived the J-curve. Business analysts, notably Tien Tzuo in his foundational work, The Subscription Economy, pointed to Adobe as the ultimate proof of concept. Once the mathematical proof was established, the industry dominoes fell rapidly. Microsoft, observing Adobe's soaring valuation and predictable cash flow, aggressively transitioned its dominant Office suite away from physical disks and into the Office 365 subscription model. Autodesk, the maker of critical architectural and engineering software, followed the exact same playbook, forcing its deeply entrenched enterprise users into mandatory recurring contracts. Across every digital vertical, from accounting software to video games to operating systems, the concept of a one-time purchase was systematically eradicated. The technology industry collectively realized that selling a product is a finite transaction, but renting access to a utility is an infinite lease on a user livelihood. Adobe's brilliance lay in recognizing that the software itself was no longer the primary asset. The true asset was the user dependency on the ecosystem. By shifting the transaction from a capital expenditure to an operational expenditure, Adobe fundamentally altered the balance of power between the creator and the corporation. The financial burden was permanently transferred to the end user, who now pays a perpetual tax simply to access the basic tools of their trade. The era of digital ownership is dead, replaced by a frictionless, invisible system of continuous corporate extraction. We no longer buy software, we merely lease the privilege of opening our own files. As the subscription economy expands relentlessly from software into hardware,